Bankers are still trying to come to terms with the letter and the spirit of the law signed by President Uhuru Kenyatta yesterday, capping interest rates at not more than 4% of the base rate set by the central bank and the interest on deposits at least 70% on the base lending rate. They never expected this, they say, and they thought the president would send the bill back to Parliament with a memorandum for the House to amend. But even though they haven't had their way, some of the promises made will still hold. For instance, the MOU signed last week, which set up a fund of 30 billion shillings called Inuka Fund to be lent to small and medium enterprises who are deemed as some of the riskiest borrowers, will still be there.
The Inuka program has got the capacity building component. The capacity building component basically tries to bring the borrower to a level where he can be able to provide information to the bank to be able to the perception of the risk be reduced, and therefore be able to come within the formal banking services, within the law.
The fund had been criticized as being a gimmick meant to sway the president not to sign the bill into law. Worse still, others had argued that there are still banks and microfinance institutions offering credits to SMEs. Bankers, however, say that with the interest rate capped, there will be no more incentives for such institutions to offer such loans, which they say were some of the most expensive.
There will be no more motivation towards innovating in that area, especially if you cannot get a return on the risk that you take towards innovating to address that specific problem.
While the banks say that the capping of interest rates will make it harder for them to lend money to high-risk borrowers, the proponents of the new law say that there has never been much distinction anyway. They say that the banks have not been formally distinguishing between high-risk or low-risk borrowers and have not been offering the low-risk borrowers any preferential treatment.
I think we are going to see banks becoming very innovative in terms of providing other services that currently are not possibly being provided by the banks. And so, and for that, we'll of course have the relevant competitive fees that will be charged for the services. So it's not trying to circumvent the law in place, but I think it's trying to become innovative, to venture into areas that we have not ventured before.
There is also likely to be a change in procedures as banks look to cut costs and make operations more efficient.
We can't say that there will be job losses. I think what will happen is that there will be more efficiency, and therefore possibly the probability of heavy employment going forward may not quite be materialized.
It will probably be another 3 weeks before the bill is gazetted and the regulations to enforce it are in place. That is when it will be clear whether loans that were taken before it was assented to will be affected by the capped rates. The banks have, however, said that they will abide by the law whichever regulations are made. Andrew Ochieng, NTV.